Hello everyone, welcome to Insurance Business TV, and with the MGAA Regional Broker Exchange coming at you from October 15th, you might be wondering what's top of mind for the association's CEO, Mike Keating. Well, in this edition, we're going to reflect back on our catch-up with Mike at the MGAA conference earlier this year, where he gives his take on regulatory matters, carrier partnerships, the economic environment, and more. Here's the man himself.
Okay, so if we look probably at the headwinds which were the sectors approaching, is that, as we've discussed today at the conference, we have a softening rate environment across most product lines. And I think it's really the ability for MGAs with their carriers and with their broker distribution to navigate that successfully. Because fundamentally, if you look at maybe some of what I'd call the sins of the past of the MGA sector going back 15 years, they have tried to grow in a softening market. And where there is still claims inflation, claims severity and claims frequency, then effectively that has hurt capital. And that has proved sort of deconstruction in the industry where capital exits MGAs. And of course, ultimately that has an issue on end customers and doesn't actually endure confidence in the broker market. But what I will say is that without doubt, the underwriting expertise of MGAs currently is the highest I've ever seen it. I believe they have the muscle memory to navigate with their partners and their brokers through these sort of challenging sort of environment to the benefit of all. But that is without doubt the key headwind which is facing into at the moment. Really interesting question. I think what we have found in a softening market that carriers, I like to use an analogy, they breathe out in terms of their risk appetite. So that actually everyone wants growth, even in a soft market. So they tend to breathe out, and therefore that their risk appetite expands actually, because otherwise if they kept it where it was, then they probably wouldn't grow where they need to. In a hard market, just to finish off that analogy, you could argue they breathe in and actually their risk appetite actually sort of shrinks. And that's where MGA is coming sort of quite clearly. So effectively aligned with sort of my observation around the softening market, obviously the economic climate is challenging. So if you go right to the end customer who are talking to their brokers will be talking about program design, talk about saving money across that program. You know, all these customers have had national insurance increases, for example, for their staff. So that puts challenge, and that is driving, in a way, the soft market where brokers are looking for better deals. The key thing is actually, certainly for MGAs, is actually to maintain and retain their underwriting discipline. For the reasons I sort of explained earlier. But again, without a doubt, it will be challenging. How long that will last, we don't know. You know, there was comment today at a conference that, God forbid, but if there's a big flood event, then that softening market might sort of be curtailed very quickly. But we're certainly likely to see it for the next 12 to 18 months. Okay, so there are a number of sort of key pillars they will look at. First and foremost, they'll look at the underwriting expertise and the team they're going to effectively deploying their capital to. That would absolutely be number one. Do they have confidence in the expertise of the underwriting team, that they know their sector, and effectively, as an MGA model works, will they lend them their money, stroke their balance sheet to underwrite on their behalf? So that will be the first factor. And alongside that, do they really know their sector? The second bit will be the level of data. Right, so you know, how forensic is their level of data in order to inform risk appetite, pricing, effectively their claims data, in order again to ensure that by deploying capital, that there's a reasonable good chance that they're going to make consistent underwriting profits. Thirdly would be distribution. So okay, so if you have expertise, and number one, and number two, that you've got excellent technology and data supporting that. What is your distribution? You know, where is the distribution? Do you know your sector, your broker sector? You know, are they going to be loyal? Are they going to give you sort of the right business in terms of meeting the further two sort of pillars? So they would be the three real key things. You know, we could go on in terms of technology. Obviously, is very important from that perspective. You know, financial sort of strength in terms of the MGA, in terms of longevity. But, you know, if I was going to choose the podium in terms of those three, then I would say team, MI and distribution. again, just actually coming from the conference from Matt Brewer's session. So one stat which is quite interesting, he has just over 100 people and he regulates 6,000 firms. So there has been some sort of music in the market that would MGAs be regulated separately because obviously they're not brokers, they are agents of capital. But what I think I would say is that what Matt has been very encouraging for us in terms of our relationship with him and our members is that if we identify through our members areas where there's unnecessary cost, duplication, requests for the same data on different areas, then that's something the association can play back to Matt and get his team to look at that and actually say, well, actually, you won't need to do that as an MGA sector. The second thing, actually, which is very topical because the consultation date closed yesterday, is the simplifying insurance consultation. And that has quite an impact on the market generally and MGAs. So a couple of examples. Clearly, what the regulator is looking to do is to create, and I'll use Matt's phrase, a bright line, if possible, where if you're a consumer, you quite rightly get all that sort of protection you'd expect as a consumer buying insurance. But if you're a business and that you have a very professional broker actually advising you on that insurance program, the regulation in that section doesn't have to be the same as what it is of a consumer. So I think that's a great way sort of forward from a proportionate regulation. The other area which I'm aware that all of the trade associations, my peers have commented on is what's called around co-manufacturing. So the consultation suggested that either a Lloyd's syndicate or an insurer could be a lead manufacturer. What we've clearly sort of fed back along with the ABI, the LMA and BIBA is that actually MGAs should be able to be a lead manufacturer, not just the Lloyd's syndicate. And the reason behind that, if I may explain that, is that capital deploys their balance sheet to MGAs who are absolutely experts in their sector, where actually that capital may not be an expert. So how that capital can be a lead manufacturer in a segment where they're not experts doesn't make any sense and could potentially lead to poor customer outcomes. So my view is that the MGA should be the lead manufacturer because they're the experts in that sector and whatever niche they're underwriting in. So we have 8% of our membership are actually on a B2C basis. It basically concentrates in the non-standard home, travel, pet, and a little bit in motor. Okay, motor is quite challenging in terms for MGA, purely around the margins, because it's a good motor book might earn sort of 69s, early 70s a ratio. So it's quite difficult when you add the expenses and commission onto that to make money. So it's starting to grow. The insurtech sort of sector obviously tends to start out in that sort of retail broker consumer sort of area from that perspective. There's always going to be a place for MGAs in that sort of retail consumer space, certainly in non-standard, certainly with climate change and what happens. I mentioned flood sort of slightly earlier, and it will continue to grow. But when you look at the composition of the MGA market and the speciality market, it is heavily weighted towards commercial as opposed to that consumer business.